Hello and welcome to AllGen's Market Update. My name is Jason Martin. I am the Chief Investment Officer of AllGen Financial Advisors, and today is December 11th, 2019, and wanted to bring you up to speed on what's going on with the market, the economy, interest rates, so that you can be informed. Looking here at the main things that are going on right now that we're seeing, the market has been strong and the market continues to go up, but we're noticing a couple things that could be changing. For a long time, large caps have been outperforming small caps, and so we're going to take a look at that, and that could be possibly coming to an end. And then we're also looking at a long time outperformance of growth stocks over value stocks. That there is a chance that could be coming to an end as well. And then actually today the Federal Reserve meets to announce if they're going to cut rates or not. So we're going to see what the likelihood of that is, not only for today but going into 2020. So let's hop right in. So if we take a look here, this chart is showing you the outperformance of large caps versus small caps over the last couple of years. If we take a look at this chart going all the way back to 2000, you can see small caps have, so how you read this chart is if the line is going down, that means small caps are outperforming large caps, okay? When the line is going up like it was from 2014 to 2016 and like it has been since the middle of 2018 to 2019, that's when large caps are outperforming. Okay, so over the long term, small caps tend to outperform large caps. However, over the last few years, and really the last about 8 years, you had small caps have not outperformed large caps. In fact, over the last year and a half, large caps have really outperformed small caps. And just to clarify, cap, you hear, stock people talk about large cap, small cap. What does cap mean? Cap is capitalization. So it's the size of the company. So a large cap would be companies over 10 billion. A small cap or small capitalization stocks are companies under 2 billion. Okay, so it's basically your large companies versus your small companies. And a way to diversify your portfolio is to hold some of both. But at AllGen, we're trying to see what area is going to outperform going forward so we can overweight those areas. So looking at this chart, you can see a blue line that I've drawn here, which is resistance. And so over the last, since 2011, during that time, you've had large caps come up to this resistance line and have not been able to outperform after it touches off that resistance line. Well, we're coming up against that resistance right now, so there is a chance going forward, an increase of probability that large caps are not going to outperform small caps, and small caps may become into in favor. Now, if over the next 6 months or so, next 3 to 6 months, if we break above this resistance, then you got to go with the opposite thinking, that large caps are going to continue to outperform small caps, and if that's the case, we want to overweight the large caps. So another thing we've been noticing is that this is now comparing growth stocks versus value stocks. So what is growth? What is value? What does that mean? Well, a growth stock would be a company that is growing its earnings or growing its revenues really fast. So think about like a Tesla or an Amazon or a Netflix, companies that are growing fast. Some of those companies, like Tesla for example, doesn't even have earnings. They're losing money, but the revenues are growing really fast and the company is growing really fast. Well, those types of stocks have been in favor over the last 10 years. So what are value stocks? Value stocks are companies that tend to trade, meaning the price of their stock is at a much lower value or price compared to its earnings or compared to its revenue or compared to its book value. So and that's kind of the Warren Buffett way of trying to buy a stock. It's trying to buy a really good deal. And so, and typically those stocks tend to pay a dividend, tend to be a little bit more mature companies. They're not growing as fast all the time, but they're a better value. Now, over the long run, going back 100 years, value stocks have outperformed growth stocks by about 1 to 2 percentage points annually over that time. Now, Fast forward to the last 10 years, and you can see really, well, actually 12 years, since 2007 all the way through 2019, growth stocks have been outperforming. So when this line is going up, that means growth stocks are outperforming. When this line is going down, value stocks are outperforming. But what I want to point out here today, as we kind of look into 2020 and try to figure out how we're going to position the portfolio, is that if you go from 1995 to 2000, which isn't on this chart, but if you remember that time period, tech stocks and large growth companies and just growth companies in general really outperformed and did really well. But what is on this chart is what happened afterwards. And so you can see from 2001 through the whole tech bubble all the way to 2003 how much value stocks outperformed. So during that time, that was a really bad time for the NASDAQ and growth types of stocks. And those stocks fell a lot, but value stocks actually went up during that time. And so now you're approaching, as we're going to go into 2020, the same level, or not quite the same, but we're getting close to the same level of where growth stocks compared to value stocks were kind of 1999-2000 time frame. So our thinking is we're kind of on borrowed time for growth stocks to continue to outperforming, meaning the time frame going forward that growth stocks are going to outperform is, we believe, limited. So we have started to position the portfolio, and we've been this way for about a year or so, a little bit more value than growth. Okay, so switching gears and looking at interest rates. The Federal Reserve is actually going to meet today to decide if they're going to cut interest rates. They've already cut them 3 times this year, which is a total of 75 basis points, or 0.75%. And the likelihood that they will cut today is very unlikely. In fact, there's a 0% chance, according to the Fed Watch tool, which kind of predicts the probabilities of where Fed rates are going to be at any point in time. So it's very unlikely they're going to cut them today. There's like maybe a 2% chance they will actually raise them, but there's about a 98% chance that they will keep them where they're at. So, but this particular chart that I'm looking at here, this is looking forward to next December 2020 to see where interest rates could be over the next year. And looking at that, there is actually about a 56% chance that they will cut rates, and there's about a 42% chance that they will leave them the same, about a 1% chance that they will raise them a quarter point. So what seems to be the most likely course is that we get one more rate cut over the next year, but it's about a little bit better than a 50-50 chance that will happen. So that's something to watch as we position our portfolios in terms of the duration or the time frame of our bond holdings. Usually when interest rates are going down, it's better to be longer term on your bonds, and when interest rates are starting to go up, it's better to be shorter term on your bonds, generally speaking. So to sum things up, we are expecting some volatility as we go into 2020. We still don't have any major trade deal, and the market has been very dependent on the news of the China trade deal, and even some different things that are coming up with trade issues with Europe, even with Mexico and NAFTA. So the market has been very dependent on that, and it's something that we continue to watch as we go into 2020. At the same time, obviously 2020 is an election year, and the election years tend to be a little bit more volatile. So all that being the case, in the same time that the global economy has slowed down this year, we continue to maintain a defensive posture. Okay, so that means we're holding less stocks than our normal asset allocation. We hold more bonds, and then, as I mentioned in our last video, we've increased gold and even some silver to protect in case we go into an inflationary environment. And all those things, all those different points that I just made, that is to put our portfolios in a position where if the market does take a hit, we should hold up really well. So that's the thinking as we go into 2020. We probably won't have another market update until the new year. So I want to wish everyone a Merry Christmas and a Happy New Year.